When deciding where to put our money, we typically face a strict choice. On one side, the quiet safety of a bank deposit. On the other, the turbulent, high-yield pursuit of the stock market. But financial institutions aggressively market a third option, the structured product. These investment vehicles make a very specific claim. They offer the peace of mind of full capital protection while still letting you harvest the upside of a booming market. This raises an immediate mathematical problem. How can an institution shield you entirely from financial loss, yet simultaneously expose your money to a volatile stock index? The answer relies on taking standard financial instruments and wrapping them inside a sealed, opaque container. If we crack that container open, we find two completely separate engines running in tandem. One is a quiet, predictable bond. The other is a highly reactive derivative option. To see exactly how these pieces interact, let's take a standard scenario. Imagine you place £1,000 into a structured product with a fixed 5-year term. Right away, the manager splits your money. They take £800 and buy a zero-coupon bond. This bond pays no regular interest, but it is bought at a discount and is mathematically guaranteed to mature to exactly £1,000 in 5 years. Your initial investment is now completely secure. That leaves £200. The manager uses this remaining cash to buy a call option on a major market index, like the FTSE 100. If the market climbs, this option captures a portion of that growth and adds it on top of your base. But if the market collapses, that £200 option simply expires completely worthless. You lose the growth component, but because the bond track still matures to £1,000, your original capital remains unharmed. By dividing the capital this way, institutions manufacture a controlled environment. They isolate the risk to a tiny fraction of your money, while using the bulk of it to build a concrete floor under your portfolio. Once you understand this recipe, you can see how financial engineers manipulate it. By simply adjusting the ratio between the secure bond and the volatile derivative, they generate a spectrum of risk profiles. This table categorizes those variations, starting with structured deposits at the top. These function essentially like a fixed-term savings account, where the return is tied to market performance, and crucially, they often carry the safety of national deposit protection schemes. Sliding further down, we find structured capital-protected products. These aim to return your original capital at maturity and offer higher potential returns, but they strip away that official government deposit protection. Finally, at the aggressive end of the spectrum are SCARPs, or structured capital at risk products. Here, the safety floor is partially or fully removed to maximize market exposure, meaning you can actually lose your original investment. Despite different marketing names, every product on this list is built from the exact same mechanical logic, just calibrated to a different tolerance for risk. Combining these instruments creates friction. The mechanics of structured products demand significant compromises from the investor. To pay for the capital protection, managers implement heavy fees that drag down your realized returns. They also place hard limits on the upside. If the market surges 50%, your participation might be strictly capped at 20%. Furthermore, these are highly illiquid arrangements. Your money must stay locked away for the full fixed term, which can be up to 6 years. Attempting an early withdrawal often triggers severe exit penalties. However, the most severe vulnerability sits completely outside the mechanics of the product itself. It involves the health of the institution issuing it. Structured products are often logged as off-balance sheet items for the financial institutions creating them. If that specific bank fails or faces insolvency, the capital protection promise shatters. You become just another unsecured creditor fighting for scraps. Structured products do not delete risk from the financial ecosystem. They simply transfer it out of the stock market and place it squarely onto the shoulders of the institution holding your safety net.